Chapter 12, Examples for Business Finance. So in Chapter 12, we're calculating the components of the weighted average cost of capital and the overall weighted average cost of capital, or WACC. We're going to start with cost of equity calculations. If you remember from the lecture and from the textbook reading, the cost of equity can be calculated in two main ways. The first way being the dividend growth model formula that we used in Chapter 7, and the other one using the security market line formula that was introduced in Chapter 11. So we're going to do an example each way. First, we're going to use the dividend growth model. So remember, that's the current dividend times 1 plus the growth divided by the price plus growth. So when we're looking at that dividend growth model, we have information here about the current dividend, the growth rate, and the current stock price. So when we're looking at that, and remember, when we use our equations and formula, we have to add extra parentheses. So we're going to start off with 3 parentheses. We have the current dividend times 1 plus the growth. Current dividend times 1 plus the growth rate. That's divided by the price. And then we add the growth. And I need 1 more parentheses at the beginning. So we get a cost of equity of 10.61%. In this next example, not all companies pay dividends or pay dividends consistently enough that the dividend growth model is that we can use that to make any predictions about the company. So when we don't have the opportunity to use the dividend growth model, we use the security market line, or CAPM formula, the capital asset pricing model that we looked at in chapters 10 and 11. So then we calculate the cost of equity. You remember the security market line is the risk-free rate plus the risk premium, which is the difference between the market turn and the risk-free rate, times beta. So we have our risk-free rate plus beta times the difference between our market return, so market return minus risk-free rate. Except, how about if I grab the actual numbers instead of the names of the items? So risk-free rate plus beta times market return minus the risk-free rate. So the cost of equity is 10.04%. Now the nice thing is that dividend policy and payment of dividends isn't always public information, but we know that we can get information on the beta of a stock, the risk-free rate of the market, which if you remember is treasury bills rate, and the market return. We can get that information publicly on almost any finance website. Now that we've looked at the 2 different ways to calculate the cost of equity, we're going to go to the next component of the weighted average cost of capital formula, which is the cost of debt. So we're going to calculate the pre-tax cost of debt and then the after-tax cost of debt. So if you remember why there is a difference between for the after-tax is because interest is a tax-deductible expense. So interest lowers our tax burden, so there is a benefit to having debt in that we pay lower taxes because of that interest expense. So if you remember from the lecture and the textbook reading that the pre-tax cost of debt is the yield to maturity on their current outstanding bonds. So for the pre-tax cost of debt, we use the yield formula. So just like in chapter 6, when we were calculating bonds, we're using the same formula. So we're looking for the yield to maturity on their bond issue. We have the settlement date, maturity date, our annual coupon rate. We want our bond price as percent of par. The redemption value is the face value as percent of par. And then the number of coupons per year, which is 2. It's a semi-annual coupon. We then get a yield to maturity on their bond issue of 4.59, which is their pre-tax cost of debt. For the after-tax cost of debt, we need to take the pre-tax cost of debt times 1 minus the tax rate, times 1 minus our tax rate of 21%. That gives us an after-tax cost of debt of 3.63%. In our next example, we are going to do the full weighted average cost of capital, or WACC calculation. So we need the different components. So we need to figure out what the value of the equity is and the value of the debt to calculate how they are weighted in the company. So in this example, we're calculating the book value of the debt and the equity and the market value of debt and equity. So we have information about the market price per share, the book value per share. We have 2 bonds, so we have to take that into consideration that we have 2 bonds. So first, the book value per share. So the book value per share is the number of shares outstanding times the book value per share. So the book value of our total equity is $45,100,000. The book value of our debt is just the par value of our 2 bond issues. So we'll add our 2 bond issues together. Just one. So we have book value of our debt of 120 million. We add those together to get the total value of our organization. Remember, debt plus equity equals assets, our accounting equation, and then we figure out what the weights are. So our equity value divided by the total value and our debt value divided by the total value. So we have weights for equity of 27.32% and the remaining in debt of 72.68. Now we're going to calculate the market value of our equity. So the market value of our equity is the number of shares outstanding times the market price. Or 344,400,000. The market value of our debt is, we need to look at the par value of our bond. So we are going to we need to add our 2 values together. So we're going to start with the percent of par for bond 1. You can see that we are trading this bond at a discount currently. So that divided by 100 times the total value of our bonds plus the percent of par for bond 2 divided by 100 times the total value of bond 2. You can see that at 108%, bond 2 is trading at a premium. So the market value of our bonds is $122,600,000. We're going to add those two together, and we get a value of $467 million. We calculate our weights for each item, and you can see that now our weights are flipped, and we have 73.75% for equity and 26.25 for debt percent. So the market value rates are actually more relevant in this case. We would use the book value rates if that was the only information that we had, but we know that the market value is a better representation of the actual current valuation of our debt and equity. So we're going to look now at the firm's capital structure, very similar to the calculations we're already doing. And let's do part A first. So the firm's market value capital structure. We have a lot of information here. We have bonds outstanding, we have common stock, we have preferred stock outstanding, we have information on the market premium, the risk-free rate, and our tax rate. So first, we're going to start with the market value of our debt. So we have bonds outstanding. So we see we have 125,000 bonds outstanding times the $1,000 par value of our bond times the bond price percent of par. So we're currently trading on the market at a premium divided by 100. So the market value of our debt is $128,750,000. For the market value of equity, we take the number of shares outstanding times the current share price. So make sure you grab the common stock. The preferred stock is done differently. Or it's the same calculation, but it's done separately. So number of shares outstanding times the share price. The market value of preferred stock, the number of shares outstanding of preferred stock versus the share price of preferred stock. Remember, we do preferred stock separately from common stock because preferred stock is a perpetuity payment, while common stock has different cash out rights in regards to dividends and stuff like that. But that preferred guaranteed dividend makes it a perpetuity, so it gets treated differently in our calculations. It gets its own separate area, not included with our equity. So we have the total market value of our firm. Then we calculate the weights by taking the value of each item divided by the total value. And if we lack that total value cell, we can copy that formula. So we have the weights. We are then going to calculate our pre-tax cost of debt. So remember, this pre-tax cost of debt is the yield formula because our cost of debt is the yield to maturity on our bond issues. Oh, yield. So settlement date, maturity date, the annual coupon rate, the bond price percentage, face value percentage, and then the number of coupons per year. So we have a yield to maturity of 5.45%. We then need to calculate our after-tax cost of debt. So we have the pre-tax cost of debt times 1 minus the tax rate. Our tax rate is 23%. So that is our cost of debt. Next, we need the cost of equity and then the cost of preferred so that we can calculate our weighted average cost. Next, we're going to calculate our cost of equity, and we're calculating the cost of equity using that security market line formula, which remember is the risk-free rate plus the beta times market return minus risk-free return. That market return minus risk-free return, or the risk-free rate, is also called market risk premium. So that's the information that we're given here. So we have our risk-free rate plus the beta times the market risk premium. So our cost of equity is the risk-free rate plus beta times the risk premium, giving us a cost of equity of 11.98%. The last item we need is the cost of the preferred. So the cost of preferred is our coupon rate on our preferred stock, or dividend rate on our preferred stock. It's called a coupon rate here, times 100, because that is the price. So the par value is 100. So that gives us our dividend rate, divided by our share price of 103%, or $103. We get a cost of preferred capital of preferred equity of 5.05%. Our weighted average cost of capital then is each item, and we use the after-tax cost of debt times their weight and add it all together. So we take the weight of debt times the cost of debt, the after-tax cost of debt, plus the weight of equity times the cost of equity, plus the weight of preferred, parentheses, times the cost of preferred. That gives us a weighted average cost of capital of 9.77%. Now I know we have only one example left, but this video is already longer than I try to make videos. So, and the next problem is kind of long. So rather than have a 30 to 40-minute video, I'm going to stop this video here, and we'll do the last example on the next